So here we go. Uh, my apologies again for the delayed start to the webinar. I guess there's days where things just don't work out as one would like them, and the best one can do is move onwards. So onwards and upwards. Thank you so much, guys, for showing up in such numerous numbers. It's bad that the one day where we broke the record in terms of number of registers, I had just happened to have a number of technical issues, but we're here. And today I'd like to explain to you all how the Darwin Risk Manager works, both conceptually, because the methodology hasn't changed and will not change going forward, but also I'd like to discuss some of the changes that you can expect from the risk manager when Darwinex reloads itself, incorporating all the lessons from the 1 year of live investor exposure with a view towards creating a new asset class and just disrupting the way people think about traders. So let's get on with it. What are we going to discuss today? It's essentially review the risk management methodology that we've used at Darwinex. This will require us to look back into what a value at risk, our strategy level risk measure, and deleverage, the position level risk measure, how they work, why it makes sense to use them. And then we'll discuss, once we've gotten everybody onto the same page, how this will change, the parameters of it will change once we move into the reloaded phase. So before I really delve down any deeper, can you guys now confirm that audio and video are at least okay now? Okay, thanks a lot, Jim, and thank you guys for all the patience. So there we go. How does a risk management framework basically work? Well, in theory, you have to start from the capital you own and the risk appetite you have for that capital, and take into account what sort of trading strategy you're going to develop. Because on the basis of those three parameters, you will then be able to set the optimal lot size on every one of your trades. So basically, you've got this in mind, and then as you face the market, you have to decide trade by trade how much leverage you're going to choose for your next position, and that's basically how the framework works. And that's really how the framework at Darwinex works also. There's a risk appetite, which in the case of investors is set to a value at risk of 20%. The capital is everyone's choice, how much they wish to invest in a given Darwin. And then, of course, they choose which Darwin they back. But there's one provision, and that is that because the investors are not paying attention to all the trades that are being opened by any given Darwin, there's a piece of software that we call the risk manager that decides at all times what the optimal size for any investor trade is, so that the value at risk of the investor is as advertised by Darwinex, which is a value at risk of, say, 20% in the past, much less in the future. That's really the framework. Now, when we think of its components, there are really two components to it. One is the strategy level risk appetite, which is done on a kind of a longer time frame. So you choose how much value at risk you're going to risk on a month. But also you have to choose trade by trade how much leverage and how long those trades are going to be, which is the position level element. And for each of these, we have two proprietary measures, two measures. On the position level, we use the Darwinex leverage, which is a measure of leverage that we'll discuss in a second. For the strategy level, we use the value at risk, and both we have to discuss before we can explain what's changing going forward. So bear with me. And in case there's anybody who's new to Darwinex, who has any questions that they'd like me to go into, please put them into your question box, and I'll try and tackle there and then, because if I lose you in any of these, it's going to be quite hard to catch you down the line in the presentation. So at its most basic, from a risk management view, what does the Darwinex risk management framework look at? Well, really, there's really only two things that we're taking into consideration. So a strategy to us is a sequence of positions in each of which you have exposure to the market, and it is all captured in this deleverage versus position duration space. If there's any one of you who's not that familiar with the interface, we're just going to come back to a particular strategy that we'll be talking about a bit later today, as it's I think it's indicative of how changes are going to affect it. But for now, let's just go, okay, if we go into the risk management space and we go to the Darwin risk adjustment, we see that to the risk manager, a strategy is nothing else than the sequence of positions that have been taken at different points in time. You have the flow over. In terms of how volatile the equity in the account was when those positions were taken. So for instance, in this case, we see that this position taken on October 21st, 2016, the equity of the account for the time that this position was open was about 3.2 times as volatile as the euro dollar at that period, and this position lasted for something between 30 and, well, say I guess looks like 35 to 40 minutes. So, and if you compound all those positions over time, they add up to the risk that you had over the last month. The more positions, all other things equal, the more risk. More things can happen if you open a lot of trades. The more leverage in each of those positions, all other things being equal, the more risk, because more leverage means more volatility, which means more uncertainty as to what can happen. And the longer the trades, the more uncertainty, because more stuff can happen in 4 hours, all other things being equal, than can happen with the same leverage on the same asset in 1 hour. So really, if you look at the gradient of risk, the more you move up and to the right, the more leverage and the longer the positions, the more the risk, and the more trades there are, the more risk as well, because of course more trades mean more possibilities of going one way or the other. That is the basic framework, and notice that there are things in it that don't really enter. So things like stop losses and take profits are not even part of this framework. So far so good. So in terms of risk management, for risk management purposes, this is, according to Darwinex, all that matters is the sequence of positions that you took, with how volatile your equity was whilst you were in those positions, and for how long did you hang on to that volatility. Whoop. Okay. So for you to understand the Darwinex leverage concept, I guess many of you are familiar with it, but I'll have to just look over it. Why did we invent like such an atrocious concept? Well, because when people talk about trade level leverage, they're doing so in nominal terms, and then nominal terms are not an adequate way to really characterize the risk of a position. Why? Because if you have a euro dollar trade and GBP yen trade, both assets have different volatilities, and the fact that you're leveraged 5 to 1 does not capture the fact that one of the two will have a different volatility. So if the euro dollar has more than the Japanese yen, then it will be more volatile, or vice versa. That's when you're really looking at, say, separate trades, and you're not really combining them into a single position. But what happens if you have a position where you have two trades open simultaneously, one USD CAD, another on dollar yen? Well, it will depend on the relative volatility and the correlation of both assets to each other for you to know how volatile your equity was at that point in time. So this is the reason why the Darwinex leverage translates the risk of any position to multiples of euro dollar leverage. So if we say a trade has a deleverage of, say in this case, 5.44, what this is saying is that the risk of this position was equivalent to a 5.4 leverage trade in the euro dollar at that point in time. It's all translated in terms of the standard anchor, which is the volatility of the euro dollar. Something's off with my computer today. Okay. So just roughly, basically to explain how the deleverage fluctuates over time in a given position. Let's say you first open in time a trade which is 7 to 1 leverage in the USD CAD. Now, because the USD CAD is typically less volatile than the euro dollar, this would imply a deleverage of 5 for the period when only this trade was open. But then at some point you choose to open an additional trade in pound yen. And because of the volatility and the correlation of both currencies at that point in time, and the fact that one was long and the other one was short, what we do is translate the risk of this position, while these two were open, into a deleverage of 9. So at this point in time, the equity in your account was 9 times more volatile than the euro dollar. And the moment that you closed the USD CAD trade, then only the pound yen trade was open, and that translated into a deleverage of 6. So what we've got here is 2 trades that overlap for a period of time that equates to 3 positions, each with their own deleverage. The first one would be 5. So this would be a dot somewhere, and let's say this was bummer. So let's say this was 1 hour. So this trade would equate to a leverage of 5 for 1 hour, and it would be plotted here as somewhere around the 5 1 hour dot. This would be a dot in here. Then this one would be a 9 to 1 for about 20 minutes. So it would be somewhere here-ish. And this is really not playing ball with me today, is it? Hang on, I'm going to fix this for good, otherwise I'll just go nuts. Anyways, not solving it. So this would have been, as I was saying, it would be a 6 to 1 for about 2 hours. I think you get the point. That's how it's all characterized. So with that in mind, what we can do, and that's the way it works, is take all these buckets of positions and say, okay, well, if typically this strategy makes 37% of its trades in the 0 to 30 minutes duration with a leverage of, say, on average, say 2-ish, and then similarly ditto for the 30 minutes to 2 hours and the 2 hours to 8 hours and so on and so forth, what we can do is do, say, 10,000 simulations with 37% of trades with a dealer about 2 times as volatile as the euro dollar, 32% of trades about 2 types of again 2 times the volatility of the euro dollar, but for 2 hours, and so on and so forth. And we can recreate the distribution of your equity by projecting forward. And unfortunately, this is all in Spanish because I've lost the presentation that I had in English. That's the delay that we've had. But what I can say is, when it comes to value at risk, if I plot the value distribution of my equity 1 month from now, if I have a VAR of 15%, then what I can say is that there is a 5% probability that I will lose 15% or more of my equity over the next month. And that there's a 95% probability that I will make more than minus 15%, 19 months, 90 out of 20, which is 95% of the time. And that's how VAR comes about. So we've got some question. So very important question by Jim. This chart is showing positions rather than individual trades, and the answer is yes. So you can see each of the individual positions, and you could even go back to the trading journal. Let me just load this. So at any point in time, I can come here and focus on and give a time slot, and I would know the deleverage for all the trades that were open simultaneously. So we're going to see in a second. So let's say this is the period I just focused on. So at this point, this trader had this bunch of trades open. I can see on the right-hand side, you can see exactly what trades were involved in the particular position, and you can also see how that translates into multiples of euro-dollar leverage. But we're talking about position. So the current position would be all the trades that were open at that point in time, and at any point, whenever a trade is opened or closed, a new position is created. That's how it works, and it's very important because the risk manager thinks in terms of positions, because that's what drives the trader equity. You have to consider all trades as one, at the same time as one single position. Otherwise, you'll miss out on the risk target. I've just opened the presentation that I really wanted, because otherwise it's being a complete mess with the thingy. I'll be back into my slide in a second, assuming our dear friend PowerPoint doesn't collapse, which it didn't, luckily. So here we are, positions. We basically project forward on the basis of how many positions are taking with what time frames and what volatility. That drives the VAR of the strategy. So just to give you a feeling for what drives the VAR, essentially it's three variables. It's how many trades you take per month, with what deleverage, and for how long. Now, value at risk is linear in trades per month and leverage, which means double the trades, double the VAR, double the leverage, double the VAR, but it scales with duration by the square root of time, meaning that twice the duration is about root of 2, 40% higher volatility. And I've plotted some possible combinations of value at risk given a sequence of trades and leverage. So for instance, if you take 21 trades per month with a leverage of 10:1, and each of those trades lasts for 1 day, then your VAR, roughly speaking, will be 40% per month. You can afford to take about 2.5 times the trades and twice the leverage if you only stay in the trades for 1/6 of the duration, and you still land with a ballpark value at risk of between 40 and 50%. And that sort of roughly gives you a feeling for what impacts it. Okay, so bear in mind, value at risk is linear in number of trades and leverage, but it scales with duration with the square root of time. That's why the longer you stay in a trade, the more you're eating into the risk. Okay, so that's we haven't really talked about any risk management so far. All we've done is risk measurement. I have explained to you how Darwinex provides you with this measure of value at risk at the top for any of the strategies. So in this case, we can see the plot of value at risk by going to the risk stability, and this is telling you the evolution of the best estimate for value at risk at Darwinex at any of these days, plus a feeling for the volatility in that VAR, taking into account the maximum and minimum VAR for, I think it's 45 days trailing period before that day. All right. Now, of course, each of the traders at Darwinex trades with the VAR that they want, but the Darwins, because Darwinex is an asset manager that takes on the responsibility of marketing the Darwin to the investors, has made the decision to offer a standard VAR for all Darwins that has been set in the past at 20%. So what is required is a transformation from the value at risk of the strategy to this, which can be whatever the trader wants and moreover changes over time, to transform that into a VAR that is 20% and is stable over time. And the question is, how is that done? And that's, I guess, the purpose of today. So the basic framework, and this is, I guess, the most important slide we'll see today is really a rule of 3. So we basically take the deleverage for the trader, the strategy, and we scale it by whatever ratio we have between the 20% target VAR and the value of the trader. So if the value at risk of the trader, say 80%, which is 4 times as much as the value at risk of the investor, what we would do would be to take, on behalf of every investor, every trade that the trader took, and the leverage that the trader chose, we would scale down by a ratio of 1:4. So if the trader trades with a leverage of 8, then the investor would take the same trade with a leverage of 2. It's simple as that. Okay, so if a trader has a value at risk of 80%, then we take the investor takes all the trader's trades with 1/4 of the leverage. Any questions on this? Because it's really as simple as that in a first approximation. Okay, so then what happens if for some reason a trader opens a trade which is not in line with its historical risk taking. So if a trader typically takes trades with a risk of between 4 and 8 of deleverage, and all of a sudden he takes a trade with 80 of deleverage, that 80 would very likely be deemed outside of the tolerance ranges. And in addition to dividing by a ratio of 4, which would give a leverage of 20 for the investor, there would be a so-called risk adjustment, which would take that 20 and scale it back down a lot further. So it would say, oh, this is completely out of whack. The basic rule is saying 20-to-1 leverage, but that's just completely, as I said, out of whack. So we're going to take 1/10 of that and just go for a leverage of 2-to-1. Okay, in that case, a so-called risk adjustment would have taken place. Again, important. So the risk management process for Darwinex is not fiddling with the stop losses or the take profits. That doesn't even factor in the equation. All we're doing here is adjust leverage. Is that understood? So that's really all that goes into it. Now, when are we changing that leverage? Well, obviously, there are different periods for intervention. So if at first it's done when the trade is open, so before investors go into the trade, this adjustment already takes place. And then as the trade lives on, because obviously we don't know, no one knows when they open the trade for how long that trade is going to last, then every X minutes, the risk manager is checking, okay, is this trade still in line with the historical risk taken by the trader? And if not, if he's not shutting it down as he normally would shut it down, the risk manager is going to shave pro rata risk exposure. So maybe it would open, say, in a previous example, with a deleverage of 20. For the first 1 hour, a maximum deleverage of 20 would still be allowed without risk intervention. But after 1 hour, if the traders still hang on to the trade, the risk manager might then be closing, say, 30% of the remaining exposure and gradually be winding down the trade, even if the trader hadn't done anything from his side. Because what we're doing here is reducing the market exposure of the investors so that it is in line with the value at risk of 20%. Okay, so basically all trades start with a duration of 0, and the longer they go on, the more likely it is that the risk manager intervenes. Because also notice that a trade that lasts 8 hours with a deleverage of, say, 2.2 is a whole lot more risk than a trade lasting 15 minutes with a deleverage of 2.4. Okay, so it's a lot more likely to intervene at the end than it is at the beginning. Is it clear why? Okay, so Carlos Eduardo is asking, what is the best way to make the Darwin behave the same as the underlying strategy? And the answer is, the first level answer is avoid the red dots. So as long as if there's no red dots, there will have been no risk adjustment, which means we're firmly in this territory, and all that's happening is that the leverage is being scaled, but basically the Darwin and the strategy are a one-to-one risk transformation of each other. The more red dots you have, the more the Darwin continues to be different from the other. So now that you've mentioned, so let's have two examples here. One is our old friend NTI, who's really a benchmark for duration and a number of other things. So you look at the equity curve of the Darwin, and you look at the equity curve of the underlying strategy, and they're pretty similar. Okay, so if we look at how many times we had to the risk manager had to intervene, you'll see that the red dots are hopefully few and for small amounts, even though in some cases we do have some intervention. So for instance, in this case, this red dot would have meant that only 1/3, 1 minus 64%, would have been opened on behalf of the investor. So this particular trade, whether it was a winner or a loser, would really not have factored so much in the Darwin as it would have for the strategy. And it's really one trade out of several many. So like a trade like this would introduce a significant deviation in what happens to the strategy with what happens to the Darwin. The less you have of these, the more similar one are to the other. If we go for somebody, say, like IVU, well, again, you've got the equity curve here, which is one shape, and you've got the equity curve of the Darwin, and basically both have pretty much, well, very little to do with each other. Okay, not sure if that answered the question. Right, so Napoleon Dynamite is asking me, will we ever be able to anticipate, pre-calculate our deleverage prior to an entry, either from an assistant tool or an MT4 tool? Well, whilst you're asking, let me put it this way. I'm just going to show you something which we have had a lot of time in the making, or in the planning. Back in the days when we were still called TradeSlide, we really already thought of a tool which would essentially tell you how much, well, basically the lot size to open any trade with, given your value at risk target. So this is very much in line with what we want to do going forward. We have invested a lot of technology into making the algorithms work on a live trade-by-trade basis. And once we launch the Darwinex Reloaded, which will be pretty much the end of the core development on the investor platform, we will focus back on providing traders with value-added tools. And one of them will be what we call the risk manager, which will do exactly as you say. It will tell you what is the ideal lot size to open spot on the deleverage that the risk manager will allow. And it will also tell you when the risk manager would intervene so that you can intervene for yourself. So that's really the thinking. But coming back to this, all that we're doing here is playing with the leverage, nothing else. And we're doing that at trade open and then at periodic intervals. One of the changes that's going to affect the Darwinex Reloaded is that the interventions or the verifications will be done more frequently. So we will basically have more eyes looking at what's going on to make sure that if the market really moves wildly, we're ready to intervene as required. But bear in mind, of course, that all the information we have is the leverage that you have and that you have chosen, the volatility of the market at the point that you choose to enter the trade. And then as long as you keep the trade open, we'll be monitoring to see if that position is still in line with the historical behavior of your strategy. Okay, I hope that should explain the basic framework that of how the Darwinex risk adjustment works. And I would now like to move on to the changes that you can expect going forward. So the first change is that we are going to halve the target value at risk for individual Darwins. So going forward, Darwins will have a value at risk of 10%, which is half as much as up to now. And furthermore, there are a number of sort of back-end changes to the risk management algorithms, which will change the shape of the Darwins. In most cases, Darwins will more closely resemble their underlying strategy, and more so than in the past. And this will require that we recalculate all the Darwin equity curves and create a new Darwin for each existing Darwin. And we will set a transition period during which it will not be possible to buy any of the old Darwins. You will only be in a position to sell up to a point where everybody will be forced to, every investor will be forced to only have 10% value at risk Darwins. Okay, so that is changing. All existing Darwins are going to disappear and are going to be recreated as new 10% new risk management algorithms. And in many cases, or in some cases, their shapes will also change. In fact, some guys who are being penalized quite a bit will become quite a bit more attractive. Okay, so that's one of the changes with Darwinex Reloaded. Why are we doing this? Well, for those of you who don't know the history of Darwinex, when we launched the investor platform, we offered each Darwin in 3 flavors, 5, 10, and 20% value at risk. To give you a feeling for value at risk, about a 5% value at risk would be about half as risky, or about a low volatile period in an index. A 10% value at risk would be about as risky as a liquid stock in a liquid index, and 20% value at risk would be a highly risky stock. And we did stop offering the 3 flavors because investors did overwhelmingly go for the 20% value at risk version. We were, in hindsight, stupid enough to heed customers' advice and offered only 20% value at risk Darwins. And we have realized that that introduces too much risk, more risk than most investors can handle. And we're seeing that whenever there are drawdowns, people are selling at the worst possible moment. And that's just not good for anybody. So that's really the reason we're going for the 10% value at risk version. This may have the issue that when you invest in a diversified portfolio with, say, 5 or 10 Darwins, as you know, Darwins are not correlated, so they tend to diversify a lot, meaning that you can easily have an 8% value risk portfolio once you have, say, 10 Darwins in that portfolio, and that's about as risky as an equity index. So once we go to the half risk version of the Darwins, you would then end up with a 4% value at risk portfolio, which may be too little for some guys. And that's why we're offering the option to leverage the 10% value at risk Darwin to twice that leverage. We'll see whether we give that option to all investors or we just do that for traders who clearly know what they're doing. But we may still give people the option of gearing up if their portfolio level leverage is safe enough. That was a really long sentence, but I hope it was understood. If not, please let me know. The other point that we're doing, so out of the 4 points, I'll explain these two in more detail. The other point that we're doing is that there are times when the risk management algos would tolerate a deleverage higher than we feel comfortable with in any circumstances. So like it could be that the solution to this equation yields, this might yield a deleverage for the Darwin, which is too high for our comfort. And we are introducing a hard haircut on the maximum leverage that an investor can take. So no matter what the algorithms say, investors will not have a maximum a deleverage higher than 10. We will not allow that the equity of a Darwin investor is more than 10 times more volatile than the euro dollar. At that point, it's too much, and we've basically introduced a hard investor leverage. That is, by the way, already in production. It's something we've already introduced for the last month. So there are cases when in the past, when certain combinations of very low volatility in the euro dollar and very high volatility in other asset classes resulted in too much leverage for investors, and we don't want to have that. So there's basically a cap to the fancy rocket science, and once it's too much, and we're not allowed more. Beyond that, what we've got is we're going to double the time window in which the value at risk calculation looks back. So we've got one example in this case where we see that the typical cycles of fluctuation in value at risk are longer than the 21 days that we had for the time window going back. And we've seen that that basically resulted in very volatile VAR measurements. So we have doubled the memory of the VAR calculation so that a curve like this going forward might be expected to be a much smoother average of the of the value at risk peaks and troughs that we see here. That's going to change. Any questions on that? So basically, you should expect a value at risk that is more stable, provided within reason that you stay within maximum and minimum leverage for your trades, and the strategy is roughly stable. This in turn will imply that Darwin's Darwin's more closely, on average, resemble strategies than has been the case up to now. On the other side, basically the VAR will be less sensitive to changes. So if you're going to reduce the VAR, it will take a whole lot longer time to basically give you credit for having reduced it than it did take up to now. So it is less sensitive. There's no such thing as a free lunch. And the other thing we have noticed is that short trades were being the risk management algorithms were intervening way too much on short trades, and they were penalizing people who know how to play with short-term leverage. So as a result of that, what's going on is for the beginning or the first half of the duration of your typical trade, the risk management algorithms will give you more leeway without intervening. But whenever you go into like longer than average positions, the risk management algorithm will have a higher tendency to intervene. So you're freer in the short term, and that you're more controlled in the long run going forward. Not sure that's understood, but that's basically how the new system will work. And so what's coming next? We will try and produce, in terms of the evolution, the new risk management algorithms are already in our pre-production environment. Many of the Darwins are ready to be recalculated. So what we'll try to do is create the 10% value at risk Darwins, offer them alongside the new ones as long as we can, possibly even before we introduce the new interface. So that everybody can get more familiar with how the Darwin will look in the future. And then we will publish the rules by which we will transition from the 20% value at risk Darwins to the 10% value at risk Darwins. But the exact details I cannot give you yet. What are the desired timeframes? Well, we're working against the clock to finalize the Darwinex Reloaded, hopefully this year. Then we will spend as long as we need trying to test that everything works as expected. And if any of you guys want to test the new environment, do let us know, because we may well need extra pairs of hands to make sure that everything is as expected. And once it's all good, then Darwinex Reloaded with the new interface, the new risk management algorithms, and a few other surprises will go live. Okay, so that pretty much sums up the core of what I wanted to cover today. If any of you guys has any questions, I'd be delighted to take them now. So there's a question here, which is, I understand that if I trade 7 strategies with different lot sizes, I will have a constant VAR only if the lot size for every strategy is constant, no matter if the volume between strategies is different. Correct. So to the extent that there is an internal consistency to, say, the 7 EAs that you have within an account, then the algos will be in a position to learn and hopefully not adjust more than is strictly necessary. But bear in mind that the more different strategies you have in the account, the more heterogeneity that introduces, and the tougher it will be for the algos to know what it is you're doing. So it can learn, but only within a certain amount. Okay, not sure there are any others. So we will allow uploaded backtests to be done with a new setup. Just as a side note, we have had the best guys in the team reworking the algorithms from scratch, so that in a couple of weeks' time, we expect the algorithms to calculate real time, meaning every time you do a trade, everything will be recalculated there and then on the spot. So things like offering calculating backtests in no time and providing even real-time feedback to traders will be a much closer reality. That's been a really long project that we've been carrying out, and it's now finally close to conclusion, and that will basically be the foundations of everything we do going forward. So the answer is yes, and we are going to work more and more in that direction. The end goal, if you ask me, would be to offer both REST APIs that algorithmic traders can program directly against the Darwinex liquidity, and also a Darwin API, so that investors can get real-time information to the behavior of the Darwins of their choice. So there's a question here. I'm afraid, Nicola, I can't really provide a precise answer to this. Probably the best thing to do here is to do some tests and understand. But at this point, I don't really have enough mental bandwidth right now to answer something like this right now. Sorry, mate. Okay, so there's a question here. It would be great if Darwinex allows algorithmic traders to provide a connection to MT5 only for optimization, not for trading. We will. Okay, that's the other change that's likely coming in the first half of next year, is with the introduction of futures. well, actually, one thing I haven't mentioned is we have now finalized the changes to the risk management algorithms that allow us to track the risk of investments that have market close periods. So futures that close at at a given price and open at a different price, that risk had a discontinuity in the price, and we were not in a position to handle. But we have now updated the algorithms so that we can manage that. And for instance, we will be updating, offering new assets like the DAX or other indices that are currently not offered on a CFD. And also we will introduce futures so that we will over time be able to trade futures, diagnose future-based strategies, and hopefully offer future-based Darwins going forward. As we do so, we will introduce a new platform called CQG that you may want to test. So you may want to test CQ or get familiar with CQG.com, because that's been our choice for multi-asset trading. And CQG is compatible with a whole range of front ends. You would be in a position to use algorithms built in easy language, TradeStation, multi-charts, NinjaTrader, and a whole bunch of other alternatives that we think are superior to anything that MetaQuotes has on offer today. So we will probably move away from MetaQuotes unless they get their act together and start offering more professional platforms going forward. Having said that, we will always keep MT4, and if demand for MT5 materializes, something it hasn't done to date, we may also add MT5 to our core offering. Any more questions? Okay, well, it looks like I've exhausted your curiosity, or I have to apologize again for the delay in starting the webinar. I'm afraid, things didn't go to plan. This has been recorded, so it will be posted to the YouTube channel in case of any of you wants to re-listen to anything. And again, we're very, very grateful for your feedback, because without you guys, we wouldn't know where to take the product. So please, please, please continue to send us feedback, even if it's not always positive. So you are our only way to learn. Beyond that, if any of you guys based out of the UK want to get in touch, we're planning on expanding our marketing initiatives in the UK. So we are more than we're more than pleased to listen to any ideas you might have, because we're going to do more in the English-speaking room going forward. If anybody wants to collaborate, do let us know. All right. Well, sounds as though there's no more questions. So thank you so much, guys, for your time. It looks like there's one last here. So Carlos, if you have any more questions, please go ahead now. We can take that offline. So we have so the question is whether we're planning on expanding in South America, and the answer is we already have a healthy bunch of users in South America. I guess the language helps, given that many of us are Spanish. But if you have any specific plans, feel free to email info@darwinex.com, and we're always more than happy to listen to anything you might want to contribute. So it would be our pleasure. Okay, guys, thank you so much. It's been a real pleasure. Take care, and I hope to see you soon with our upcoming webinars. If you have any suggestions on things that you think warrant a webinar that haven't already had one, do let me know, and I'll try and program accordingly. Okay, best wishes. Take care. Bye.